Imagine you're a detective, searching for clues that reveal the true strength of a company. One of the most powerful tools at your disposal is ROE, return on equity. But what is it really, and why should it matter to you? ROE is like a magnifying glass that zooms in on a company's ability to turn its shareholders' investments into profit. Simply put, it shows how much profit a company generates with the money shareholders have invested. The higher the ROE, the more efficient a company is at using its equity base to create profits. But here's the twist: ROE isn't just about the numbers. It's about what those numbers say about the company's leadership, strategy, and market position. Imagine two companies. They both are making the same amount of profit, but one has a much higher ROE. This company is not only more efficient, but might also be operating with a competitive edge, using its resources more wisely. But beware, ROE can also be misleading. A high ROE might be a red flag, indicating excessive debt or unsustainable practices. It's a double-edged sword that can cut both ways. So, how do you use ROE to make smarter investment decisions? Think of it as a starting point, a way to shortlist companies that are potentially strong performers. But don't stop there, dig deeper. Compare ROE across the same industry. Look at trends over time, and always consider the bigger picture. ROE is a powerful indicator, but only when used wisely. The next time you're evaluating a stock, let ROE be your guide. It's not just a number, it's a story, a clue that could lead you to uncovering the hidden strengths or weaknesses of a company. Are you ready to decode it?